Rothschild, nothing I ever say is any kind of investment advice. Welcome to the series where we review The Intelligent Investor, revised edition by Benjamin Graham. This is a revised edition. The original was 1949. This is from 1971, 1972 by Benjamin Graham, godfather of investing. In this episode, we will be reviewing Chapter 1, the title being Investment versus Speculation, Results to be Expected by the Intelligent Investor. The first quote of this chapter I wanted to bring up, that this chapter is all about the portfolio policy for the individual non-professional investor. And our first subtitle is Investment versus Speculation. One of the first main quotes that I wanted to bring up was that he quotes security analysis. This one right here, the Bible of Investing, second edition. He states, and I highlighted this in my series of reviewing security analysis myself, an investment operation is one which, upon thorough analysis, promises safety of principal and adequate return. Operations not meeting these requirements are speculative. We go on to note that after the Depression, all stocks were considered to be speculation, while intelligent investors did not see it that way. In fact, when prices of something that is giving a very nice return, stocks being super undervalued are the opposite of a speculation, but one of the greatest investment opportunities of all time, really. And then you have opposite times that he mentions in 1972 where everyone is buying anything is considered to be an investor, not a speculator. It doesn't matter what stock you're buying. If you're buying stocks, you are an investor, sir. This part of the chapter is largely basically highlighting the fact that there are times when everyone is in love with stocks, and there are times when everyone hates stocks. And you never know how long it's going to be before you get to a scenario like that. Thinking in 2024, the last two times arguably people were hating on stocks were, the great financial crisis and the dot-com bubble bust in most recent history. More so the dot-com bubble bust, I would say, only because of the amount of mania in that dot-com bubble. And, personally, I think we're seeing that in technology right now, June 2024, especially regarding AI and anything that is using AI or is going to use AI. Well, that's worth just like an infinite amount of money. It's not going to end well, but I digress. Continuing to emphasize the point, quote, attitude of the public toward common stocks in 1948, when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. 90% of people asked were opposed to the purchase of common stocks. Is that what we're seeing today? If you go over to your neighbor's house right now and ask them about stocks, what will they tell you? Will they say, oh, no way. There's no way I'd get involved with that. No. We're obviously, quite extremely obviously, not in that scenario, in that position. Moving on through the chapter, he goes on and on, basically about how dumb people are. And then we have a quote that I wanted to highlight. In most periods, the investor must recognize the existence of a speculative factor in his common stock holdings. Fairly self-explanatory. Again, this first chapter, it's sort of acting more as still an introduction, kind of like encompassing what the rest of the book is going to be about. But it helps organize our brains a little bit before we get deeper into these subjects. Next notable quote is that some speculation is necessary and unavoidable. So even if you are 1,000% sure that you're buying something that is worth more than what the market says, there is still speculation. One thing that I've said before in some of my videos, I've made a lot of videos now, but you never know how long something can remain undervalued or suppressed. And it can get to the point where it stays suppressed until it actually plays out, and the speculators that were holding the price down are actually right in the end. So I continue to digress, and then we have a quote here: there is intelligent speculation as there is intelligent investing, but there are many ways in which speculation may be unintelligent. Of these, foremost are speculating when you think that you're investing, speculating seriously instead of as a pastime when you lack proper knowledge and skill for it, and number 3, risking more money in speculation than you can afford to lose. And we go on to mention that speculation / gambling is, part of at least speculation and gambling is using margin and buying, the popular stocks, pop stocks we should call them, in my own estimation. I find it very notable and interesting that he would never have written this in Security Analysis from 1940 that I read, but he actually says this in this edition of this book, that it can be fun to speculate, and he advises using a separate small account to do so. And continuing in the same vein, never mingle your speculative and investment operations in the same account, nor in any part of your thinking. So if you're going to speculate, he says, do it. Have fun. Know that you can lose. And never consider your speculations, never cross speculation with investment. Keep them separate, is what he's essentially saying here. Again, there's a lot more nuance and detail regarding this. As I found out in this chapter, similarly to Security Analysis, everything he says always has a but. He says this long thing about how something works a certain way, and then he always ends it with, but all of that might be wrong. And so, anyway, I digress. Generally speaking, we recommend that the investor divide his holdings between high-grade bonds and leading common stocks, that the proportion held in bonds never be less than 25% or more than 75%, with the converse being necessarily true for the common stock component. He later repeats that same point in the chapter. He basically alludes to, if bond yields are higher than stock dividends, bonds become more attractive, relatively speaking. So that speaks for itself. And then he has a statement that basically says that stocks can help fight inflation. Obviously, when you have inflation, when everything bought and purchased is relatively more expensive, the stocks automatically, when you have even if the yield is smaller than what you can get on a bond, over time, if you have inflation, that percentage can stay that percentage, but when the nominal value goes up relative to the stock price, if the stock price is increasing and the earnings are increasing, the dividends increasing, then that amount can even grow more than the amount of that bond, even though the percentage is lower. That's how inflation works. That's how stocks can help fight inflation. I'm looking at my notes here. I seem to have forgotten there's a footnote in there that talks about tips being invented in 1997 and how I thought I wrote that in there, but I don't see it now. But anyway, that that would have actually been the best investment in retrospect in the 1970s, but that didn't exist then. But we have a tool now that can help fight inflation. So if the inflation we're experiencing right now in 2024, for example, were to continue, we end up with stagflation, as is entirely possible. TIPS, TIPS, Treasury Inflation Protected Securities. If I happen to be wrong, which is impossible because I have a crystal ball, and inflation continues to be bad, or even out of control, TIPS might even be the best possible investment right now, moving forward. We have mentioned that cash equivalents proved to be better investments in 1964 than common stocks, in spite of inflation experience that in theory should have favored stocks over cash. So that's the always a but, good old Graham. So stocks help fight inflation, but it's not always, doesn't always work out that way. And then we have a quote here: defensive investors should be able to account on the current 3.5% dividend return on his stocks, and also on an average annual appreciation of about 4%. And again, this is like a snapshot in history, but you don't really find a lot of like high-end stocks that give you a 3.5% dividend. Those that do provide a 3.5% dividend are often attributed today as being like value traps. Like, it seems like a good return, but isn't actually. Like, it seems like all of the most sturdy stocks, there's a YouTube channel called Dividendology, where his goal is to live off of his dividends. And on his channel, I just find it fascinating that he's finding all of these stocks that, yes, the dividend in nominal terms is increasing, but it's only like 1%. Like, I think markets are ripe for a correction there, especially how can you possibly have a 30-year Treasury guaranteed bond yielding you right now over 4.5%, and supposedly safe value stocks that keep going up in value that are giving you 1% or less? It's like, for all things being equal, you'd have to have the price of these stocks, these supposed value stocks, drop by 75% to get to that 4% dividend yield to be equal. And again, stocks are not guaranteed. Any stock can go to zero, whereas a treasury bond, it's a absolute guaranteed return of 4%. This is just why I continue to be just blown away at everything that's going on in markets today, and how I do think, with my crystal ball and all, we are due for a major correction, a major return to like a normalization of security pricing. So, but anyway, we'll continue in this chapter for now. He entertains, again, this was from the introduction, the idea of going 100% in bonds, even in 1971. But he admits uncertainty of results, but maintains that it is probably best when stocks yield so low compared to bonds. And if he thought that in that period, I wonder what he would think today. It's even worse. It's much worse. The difference between the yields on treasury bonds and like top end value stocks, it's insanity. But let's move on. So, with that said, he states, but there's always a but with Graham. There is always the possibility, through we consider it remote, of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars. Okay, finally we get to that footnote I was talking about, and I said this happened, LOL. In other words, yes, inflation. It was just starting in 1970. We peaked 10 years later in 1980. It's just incredible how high guaranteed yields got. But then that's where the footnote mentions the tips. Not didn't exist until 1997, but would have been really best through this decade over stocks or regular bonds. Moving on in this chapter, we have a conclusion that sorry for misspelling, there's no red wiggly line under misspelled words in Notepad, which is my preferred method of sharing things, but let's go on. Conclude somewhere between min-max 25, 75 through 75. 25 is best depending on conditions. So I have mentioned this ratio before in previous videos. I didn't actually know that it came directly from this book. I thought it might have come from this, but anyway, so basically, what he's saying here is that at any given time, depending on the conditions, he says you should never be less than 25% stocks and more than 75% bonds, and equally the opposite. Never more than 75% stocks and 25% bonds, depending on the conditions. And in my personal opinion, once again, for 2024, I think it's the scenario right now where 25% stocks and 75% bonds makes most sense. But who am I? I'm just the guy with a crystal ball. But in all seriousness, again, yield on a 30-year treasury bond versus, a dividend stock fund. Eventually, things will make more sense, and they don't make sense right now. So I found this to be a fascinating quote here. He says, moving on, it should be remembered that between 1949 and 1969, the price of the DJIA, that's the Dow Jones Industrial Average, had advanced more than 5-fold. So 500% return, or I think 400% return actually. So while its earnings and dividends had about doubled. Interesting, right? So earnings only going up by double and the price going up by 5-fold. Speechless. I'm speechless. So this previous section was about expectations, methods of defensive investing, and then the following section is about results to be expected by the aggressive investor. And he states that the methods typically of the aggressive investor are: number 1, traders; number 2, short-term, these are people like day traders, people that are going in and out, trying to take advantage of swings in the markets on a daily basis. And we have short-term buying on speculation of good news. These are people that are, depending on some kind of announcement from the government that they're just going to give infinite amounts of money to anything that has the word green in it, or betting on earnings being much more than what the market's anticipating. And then the last category being long-term selection of growth stocks based on earnings growth or potential earnings growth. And he views all three of these methods as generally pretty negative. And then he states, very similarly, my note to what I saw in security analysis, he may be wrong in his estimate of the future, or even if he's right, the current market price may already fully reflect what he is anticipating. So just because you think earnings are, and I see this all the time, especially now I'm following Gareth Soloway's show, let's say the official consensus estimate of a company's earning is $100, and it comes out at $200, but then it comes out at $200 and the stock market that stock price collapses. Well, guess what? That 200 price earnings was already priced in, and you're the last one to find out, and that happens all the time. And then he mentions that only Rob's child has a crystal ball. That's me, of course. I kid, but he says something basically about, nobody being able to predict the future, obviously. And then we have a good quote here: an astonishingly large proportion of the trading in common stocks, those engaged therein, don't appear to know, in polite terms, one part of their anatomy from another. I love when Graham does this. He did this in his 1940 book, Security Analysis, too, where he tries to hold back at how angry he is at the stupidity of what happens in markets, and I love it. But I digress. We have a next section mentioning about how there's arbitrage and market making. Basically, he doesn't say market making, but similar things going on, and then how losses can actually occur in arbitrage, like failed mergers, and of course you'll have periods. I think they even mention a period, at least in footnotes or something, about how we have too many people trying to take advantage of every single arbitrage, and eventually the profits evaporate to the point where there's one error, and then you lose more than you would have gained from all of the arbitrage situations in that period. Funny enough, in 2024, we've had great arbitrage opportunities over the past at least 5 years. So, it's interesting how some of these obviously easy ways to take advantage of, let's call them market inefficiencies, can be great and then go away and then be great again. So, again, we haven't had a Great Depression in quite a long time. Before the Great Depression, I'm going to note right now, by the way, sorry about all the digressions, depressions were common. They happened all the time. We haven't had one for a very long time. We're overdue. Next, we have a mention of the Rothschilds. He says that this quote comes from the Rothschilds: buy cheap and sell dear. That word meaning when they're dearly held, when something's dearly held. Oh, it's going up forever. Apple stock and Nvidia stock come to mind when we think of that word dear, don't they? Maybe Bitcoin as well. And he says here that, quote, after 1949, this formula no longer worked, and he's mostly referring to, I believe it's the 2 decades following 1949, where, like I said before, the price of the Dow Jones went up by 5 times while earnings only went up by double. And then another mention in this same area that, how Dow theory, if you don't know anything about it, look it up, look into it. It provided splendid results for 1897 through 1933, and its much more questionable performance since 1934. So, like I just said, it's very interesting how one technique that is solid, that works, that's like makes sense in your head, can work great for one period and not great for another period, and then it can come back later. So it's that idea is new for me in this book. He never mentioned any of this kind of rotation of methodology in security analysis. He was kind of seeking the margin of safety, and like that's it. Moving on, bargain issues: selling at less than their share in the net current assets, working capital alone, not counting the plant account or other assets, and after deducting all liabilities ahead of the stock, virtually disappeared from the stock market in the next decade until 1970. And he says, so, interesting period, right? That would be 49, 59, 69. For 20 years, this dependable method of like seeking out like the perfect stock. Even Warren Buffett, he still says this today. He said recently, stocks are endlessly picked over, and he can't find a bargain anywhere. I feel like I've found bargains actually right now as of June 2024. Nissan's stock, actually Mercedes-Benz as well, seem to be excessively cheap compared to their historic earnings and tangible asset values, everything. But anyway, sticking to the chapter, last sentence, he says, we shall try to develop one or more such approaches to stock selection for use by the active investor. So once again, this first chapter is still acting more as still an introduction to the book. We didn't really get into much depth, but kind of went over a bunch of like subjects that we're going to be following throughout the book, or maybe at least this section of the book. So that's all I have for chapter 1 of The Intelligent Investor by Benjamin Graham, 1971-72 edition, the revised edition. Hope you enjoyed. Thank you for watching. Make sure you read the chapter before watching the video. Again, these videos are to act as like a review and like a modernization. Like let's take the text, let's put it in today, try to see how it kind of might function today a little bit, and that's what this is all about. Again, hope you enjoyed, and thank you for watching. Rob's Child.